If I'm going to spend lots of money, we don't do it that way. We use policy loans and try to optimize our cash.
There's some really good partnerships out there that do it right. And then there's other types that try to embellish and focus on one aspect and ignore the others and put people into products that are inherently going to collapse down the road.
How much money do you want to spend, or how much death benefit do you want? You wouldn't build yourself a little one-room efficiency apartment and then make the addition the house on the back end of it. Most people would build the house a solid base, a solid foundational place to live, and as things grow they add additions to it. We're going to find a top level policy, find out exactly how much you qualify for, and then we're going to structure it to fit your life and to make sure that this doesn't put you out, but it is going to improve everything in your financial life.
The first thing you're doing by doing this is you're fulfilling that moral obligation that you have as a father to ensure that if you walk off this earth early, your wife, your children, your beneficiaries are provided. We're not saying do this instead of real estate, do this instead of crypto. We're saying do this as your foundation and go do those things.
Hey, Hans, back at it. How are you, man?
What's going on?
Oh, nothing. I just got back. I went out and bought all the kids some bikes. I did not take a policy loan because we got a great deal actually there's a local bike store that closed down, so they were kind of fire selling a lot of stuff really cheap. So I went the old cash route, man. Dave Ramsey would be super proud of me. But it was the fast and easy way to get it done.
Yeah. Well, sometimes rice and beans are good, but usually not.
Yeah, that's right. And sometimes cash works, when you got to move a little bit faster, like I had to there. And, now my kids get the enjoyment of the bike. So if I'm going to spend lots of money, we don't do it that way. We use policy loans and try to optimize our cash the way we teach here.
Yeah, well, it's unfortunate for the business, but great for you. Great for the kids.
Yeah, it sucked. There was an older couple that owned this bike store, and they have a couple other businesses too. Their mechanic, unfortunately, had some health issues, and they couldn't keep up with all the internals, so they closed down. Yeah, it worked out for us.
Yeah, not bad.
All right, man. So we've talked, I'd say, in the last 8 or so episodes, we've kind of gotten a lot into like the philosophy of why we love whole life insurance, why we think it's morally right for people to utilize this asset, and kind of like how the banking function works. But we haven't really talked about any kind of mechanics or how-tos. So let's just have a chat about how things work with IBC. So like a big picture thing of like, if I'm coming to you, Hans, and I say like, all right, dude, you've been talking about this stuff. You're obviously really into it. It sounds great, but like, how's it work?
Yeah, definitely a question we get a lot. And sometimes a question we don't get because we'll be talking about this and people say, okay, this sounds good. And then they'll go online and look up and try to find it. And then hopefully there are good outlets for it. There's some really good partnerships out there that do it right, the Nelson Nash way it's supposed to be done. And then there's other types that try to embellish and focus on one aspect and ignore the others and put people into products that are inherently going to collapse down the road. And so we've had people come back and talk to us and say, hey, thanks for telling me about IBC. I got a policy set up, and that's awesome for them, assuming it's done right. But we realize that, we're talking about the philosophy behind this, and we're talking about how great it is, but people often don't get just the 101. So we're going to talk about where we start. So conceptually, before we even get into a little bit of the how-to steps, one big distinction that you've got to make at the beginning is anything you've heard about whole life to this point, any whole life policies you've had, very likely were the standard base only premium whole life policy. And a lot of the reputation of whole life comes from that kind of policy. So there's another type of premium that allows us, in conjunction with what we normally think of as a whole life policy, to get this growth much faster. That is a common criticism when people view this as an investment. So what are those two types of premiums?
So we've got what is generally known as base premium, and that's just the standard. So actually, sometimes if you think of this as like a base camp, you've got your main structure, right? And then maybe you're going to add stuff onto that. But if I just walked into any general insurance company, any of the, who knows how many hundreds, maybe thousands out there that can offer life insurance, and we're not talking about any specific types, just any policy. And you said, I want to get whole life insurance. And they might ask you one of two questions. They're going to say, well, how much money do you want to spend, or how much death benefit do you want? They're going to put in their little gonculator there. The software is going to spit something out based on which one of those two you wanted. If you said, I just want $100,000 in life insurance that's going to last forever, whole life insurance, they're going to come back and say, hey, this is what it's going to cost a month. That is the base premium. So you're just going to pay a monthly, or they're actually going to give you an annual number. Typically, they're going to give you an annual premium or cost of that death benefit. And that's cookie cutter vanilla. So it's actually a phenomenal asset, especially if you get it in particular ways that I think we're going to talk about here in a moment from specific companies. But it's slow to build cash value. It will 100% work for the infinite banking concept. It's just going to take time. Still a great asset, still provides all the protection we want, but that is base premium. And then there's another side of that. It's what's called paid up additions. And different companies call it different things, but typically PUAs is what it is known as. And a paid up addition is kind of like buying additional miniature premiums, and you're going to attach them to that base. So that's why I like to think of that. That's like the base camp, right? And if I want to add a room on, I've got this little additional portion that I'm going to buy. I'm going to buy one little shot of death benefit. It's like buying a miniature policy, and I'm going to say, if I want to inject a little bit of money in, and then I'm paid up. It's done. So we structure these so that we have base and paid up additions. And those paid up additions are put on top. That's what gives us a lot of cash value up front, because it's kind of like you've paid for all of that insurance and it's done, and you don't owe any further premium. So you're getting all the equity in that. So it's like making a large payment against your house, if you will, or just paying for, if you put an addition on your house and you paid all cash for that addition, it's going to increase the equity in your home by quite a bit, because you've increased square footage, you've put more rooms on, maybe a brand new kitchen, and it's completely paid for. You didn't take out a mortgage. So you get all the equity and your net worth on all that cash you put in. So let's say that addition cost you $100,000 in your house. It might increase your equity by 100, it might increase it by 90, it might increase it by 110,000. I don't know how your market would work, but you would have all that equity immediately, because that portion of the house is completely paid for. So our paid up additions on the whole life insurance sort of works the same way. So when we structure these, we have to have the base. And there's a lot of stuff out there that talks about ratios between how much base premium and how much paid up addition. And that's important to us. I'll let you talk about why that's important, but you have to have a death benefit to do anything in life insurance. So we need a solid base. What I mean is you wouldn't build yourself, a little one room efficiency apartment and then make the addition the house on the back end of it. Most people would build the house a solid base, a solid foundational place to live. And as things grow, they add additions to it, and they add smaller additions to it. They don't usually do 10x of their original house, right? So the base creates the death benefit. You've got to have a death benefit. It's what life insurance is. And then we add on these other things that give us cash now, equity now, that we can start utilizing and leveraging in the way that we've been taught with infinite banking and the way that we teach. Does that make sense? Did I explain that well?
Yeah, that's good. And people might, what you need to realize is that when you make that paid up addition, that little additional shot of insurance, that doesn't generate that much death benefit dollar for dollar compared to the base. And so even if your annual premium, even if more than half of that, say 60%, is going to the paid up additions, that 40% that's base is deriving much more death benefit, which is why we need that base in place. There's two analogies that are really helpful. In addition to Brian talking about making an addition to your house, most people understand a mortgage and they understand their monthly payment. And so a common analogy that makes sense and helps people kind of click with this idea is, if you understand that after paying your mortgage for a year, you have very, very little equity, maybe a couple percent, almost all of that, due to the front loading interest structure of a mortgage, is going to paying interest. And so you have to pay for the full 30 years to get that full equity. You could somewhat make an analogy to that being your base premium. You make your first base premium, you don't have hardly any equity. You make your first annual premium payment on an insurance policy, you don't have much cash value, kind of the loose equivalent of equity in this analogy. But if you were to make principal only payments in addition to your standard, like your monthly mortgage, those principal only payments go entirely to your equity in the house. So an extra $2,000 in principal only is going to generate $2,000 of equity. In a similar way, making a $2,000 paid up addition on top of this base policy is going to yield close to $2,000 of cash value immediately because there's no more scheduled payments. One more analogy that helps is Ryan Griggs, who's an economist in this space, makes an analogy that if you were to go to Costco and purchase a TV for $1,000 with a 30-day return policy, and you agreed to do 4 equal payments of $250, and you make your first payment, and then a week later you decide to go in and return the TV, would they give you a refund for $1,000? No, you haven't paid up the TV. They would give you the refund for the portion that you've paid. Whereas if you walk out the door of Costco having paid $1,000 for that TV, and then you decide to return it, well, you've paid up that TV. So the difference being, in one, you have future scheduled payments that go into building your equity in the TV or in the policy. In the other one, you've paid for it in full. Paid up addition, paid up TV is a pretty good analogy to think of.
And I'd like to add it also on top of that before we move on. When you make those PUA payments, like he said, it's like giving you a large equity payment. But on top of that, it is buying you more death benefit. And that is important. And I think that we often minimize the importance of death benefit in the infinite banking world among practitioners and among all the stuff you see online. It's really minimized. And the death benefit is so important. But depending on your age, that could buy you 5 times the amount in death benefit that you've paid. So if you pay $1,000, you could get $5,000 in death benefit added onto your policy. And that death benefit can't shrink. It's guaranteed forever. It will never go away from that point forward. So that's the only place that I think that's a phenomenal analogy you made there. But the only place it falls apart is, or doesn't fall apart, it doesn't track, is that every PUA payment of that large equity extra payment actually gives you more death benefit. Whereas in a house, it's not actually increasing the value of the house. It just pays down the mortgage some more, giving you some more equity. So small difference there is you've increased the value of the asset that is the whole life insurance policy every time you buy more PUAs.
Yeah, for sure. And when people have their idea of, if you've had just your standard base only whole life policy before, and you've had an experience with that, and you understand that it takes a while to grow that cash value, you have the same rights in that contract that we talk about here. You can borrow against it. You can do all the same things with that, but it does indeed take longer to get any kind of substantial growth on that. And so by using this PUA in the early years of the policy, we are for dollar for dollar put into the policy, we're rapidly accelerating the schedule at which we can have a substantial amount of cash value to use. And so that's why, I have, within one premium payment, I had 2 rental properties funded out of this, and we'll get into that's like for down the road, but we set that up just to show, kind of on a technical level, what one of the biggest differences between this and what you might be used to with whole life insurance. And so that gets us to the first criteria that we use. And one of the first decisions that you might make as a consumer would be company selection. So Brian, you want to cover a few of the things that we look for in a company, and not just what we look for, but what a consumer might not know to look for, because a lot of this is new to our prospective clients.
Yeah, and so anybody out there, if you're, no matter what, I mean, like Colin suggested, I would suggest starting with infinitebanking.org. Go to the practitioner finder, find somebody who has studied this, learned it, and understands what they're doing to set you up properly. Or you could also go to remnantfinance.com and find Brian and Hans. But the first thing they're going to look at, if you want to do this properly, is that you're going to pick a mutual company. Now, there's 2 types of companies out there. There's mutual companies and there's stock companies. And it's a major difference. They're both going to provide a death benefit for you. They are both going to provide good protection of your income, and they're both going to give you a tax-free transfer upon death. And from there, there's still more similarities, but the differences start to compound beyond that. And so we want a mutual company. What a mutual company means is that you are a part owner as a policyholder of a whole life insurance policy. So when the company experiences profits, which the companies we've chose have done for a long time, they're going to share those profits with the policy owners in the form of a dividend. So if you think about the game Monopoly, every time you go around, Hans, what do you get?
$200.
Every time you pass go, you get 200
yeah.
bucks. Yeah, so you get $200 in that game, and that's standard and fixed. Just like that, we get a dividend. And so every year they're going to share the profits with the policy owners. So every time you go around the whole board, you're going to get some form of a dividend. It's not going to be 200 bucks. It's going to change. It's going to go up forever. On the other side of that is a stock company. So the stock companies, like I mentioned, their profits get shared with the stockholders, the shareholders of the company. So somebody invests in, a company XYZ that's listed on the stock market. When they're profitable, that goes back to the stockholders. So you are not a part owner. You are not sharing in the profits of the company. Huge difference. So only practice this with a mutual company. Now, from there, Hans, once that narrows it down, and I'm gonna just pulling this out of my hip pocket, say there's maybe a dozen companies total that work well, mutual companies that work well for IBC. What makes them work well?
Yeah, one thing we look at is track record, as you'll want to do with any product you're going to invest money in. We only use companies that meet the criteria of, in addition to being mutual, have been in business for over 100 years. One of the companies that we frequently do business with has been in business since 1877, so they have a 147-year track record. Not only 100 plus years, but having paid a dividend every one of those years. So through the Great Depression, through World War II, through the Great Financial Crisis, through any ups and downs in the market, they have been profitable. And that gets back to the fact that they're a contract based, or the fact that the policies are based in a legal contract. They don't get to not perform. And so they're a lot more conservative. They're not doing the speculation. And so these companies are mutual companies, 100 plus years, and they paid a dividend for every one of those years. And we brought up the discussion of the two types of premium before, just to show how important that concept is, because that is one of our criteria as well, that the PUA rider, and a rider just being an attachment to the policy that allows you certain rights. The flexibility in that PUA rider is also very important, because companies, that varies by company, but we don't want our clients to be basically handcuffed to having to pay the entire PUA on the policy anniversary, or lose the ability to do so in the future, or variations of whatever companies use as the flexibility of that rider. And so we want, and the companies that we do write with, allow you to pay up to the amount that is your preset max at any point that you want throughout the course of the year. And then they also have a catch-up provision where you can pay for a past year that you missed. So we want that flexibility there, and that those factors narrow down the list further and further until there's close to single digits companies that actually meet these criteria.
Yeah, and I mean, and really, we are Nelson Nash loyalists, and there's only 5 companies out there that support the Nelson Nash Institute and what they're trying to do. So it makes it even easier to narrow it down more. We like some of the mid-sized, some of them are actually pretty decent sized companies, but they provide the most, the really large flexibility, have great riders, great financials. That's another thing I would say is, we also want to make sure that they do have very strong financials. You can look at Comdex score, you can look at how their ratings are, and such. So that's important too. We want to know that they have a lot of cash reserves, have done well through all of these markets, like Hans mentioned, even 2008.
Yeah. So we can do business with different companies. We typically try to fit the client's goals with the company that makes the most sense, but it's not something that you need to overthink as a consumer. You should know that these are strong companies, and we do indeed vouch for them. But it's not something to overthink, because we are filtering through this criteria and ensuring that the only policies that we put people in are ones that provide the flexibility to meet their goals. So let's just say I have decided I would like to explore this further, Brian. What am I going to do? I go to remnantfinance.com, I reach out for a clarity call. What is the general process from I'm curious and I'd like to learn more to implementation?
Yeah, I mean, the first thing you're going to do is reach out to us at info@remnantfinance.com, or just hop on remnantfinance.com, schedule a clarity call. There's buttons all over the website there to do so. So we're just going to spend about 20 minutes. And the first thing really is we're just going to have a chat and see if we make sense, see if we are aligned in the way we think, if we want to do business together, if we're a good fit for each other. In that 20 minutes, that clarity call, we're going to kind of talk about what some of your goals are, maybe your present position, and do a quick freedom audit of, just kind of run through a handful. It's about 15 questions, find out kind of where you are and where you want to go and how your money's flowing through your life right now and if it can be optimized better. Quick, easy call, and there's no strings attached to that. It's just to find out if this makes sense for you and if we as a company make sense for you. From there, we'll hook you up with a strategy call and with one of us, and then Hans you can go ahead and talk about how that usually goes.
Yeah, we get we'll go more into depth with the kind of a holistic overview of your goals as well as your current financial situation. Where you are right now represents the best information and guidance that you've gotten to this point. So can we help optimize that a little bit? Can we point you in a different direction? What do we need to do to get you to those goals? So that's going to be the strategy call, and we're looking at not only does it make sense for you to implement IBC into your financial strategy, we're also going to talk through some other ways that you can improve and shore up your defenses, get that protection layer in place. We want to make sure that we're not just trying to write a policy and walk away. What we would like to do as a business is to maintain a relationship with everyone who goes into business with us, where we are actually continuing to follow up. So we want to get that holistic overview and make sure that we are tracking with your goals, because we intend to do that for the long term. When we decide that we want to move forward with this, we typically try to go get an application submitted. Unlike most financial products that you could get into, if you want to go buy a mutual fund, there is no criteria. They are going to take your money, right? We're not going to take every client that comes to us. It doesn't always make sense. We're not going to put someone into something that's not sustainable for them or that's not going to meet their goals just so we can get a policy in force. We want to find out, one, do you even qualify for insurance? Because we don't want to spend all this time trying to do the application and everything if you are not insurable. And it should pique your interest that this is the only financial product that you have to physically qualify for in addition to financially qualify for. So the application process is going to get the ball rolling. It's going to obligate the company to underwrite you and give us an answer on, are you insurable? What is your rating and for how much? That doesn't commit our prospective client to anything, but it at least gives us a starting point where we know how much we can insure you for, if we can at all. That is something that we want to get going. We're going to get that application ball rolling and get that answer from the company before we decide if we're going to move forward.
Yeah, and that underwriting process can sometimes take, it could be seen it as fast as 2 weeks, and I've seen it actually unbelievably as long as 2 months. But the cool thing is we get that ball rolling, and that gives us some time to maybe have another meeting or two and get a little more in the weeds about how this can fit your life and look at your financials and how you want to actually structure your policy. So we're gonna find a top level policy, get you, find out exactly how much you qualify for, and then we're gonna structure it to fit your life and to make sure that this doesn't put you out, but it is going to improve everything in your financial life. So that way, when the decision comes along, we can roll right into implementation as quickly as possible and have you taken over the banking process in your life. But I want to actually go back to something you said, Hans. You said that we want to find out if you're even qualified. Well, what if a person isn't qualified? Does that mean they can't practice IBC? Like, what if somebody has had, a bout of cancer or has something going on in their health that they won't qualify, or should they just forget about this and go back to the mutual funds, or forget about this and go back to spending cash on bicycle?
That's definitely, we're not just going to put you on rice and beans as soon as you don't qualify yourself. That's part of what we do in a strategy call is you need to have an insurable interest in the policy that you're going to own. So you have an insurable interest on yourself, that's a given. But if you're not eligible for insurance, there's different parties in the insurance contract. There's the human life that's insured. Of the parties, that's the only one that has to be a person because we're evaluating their health and longevity. But the owner of the policy could be an LLC, could be a charity, could be a trust, or it could be an individual. A lot of times we're the owners of our own policy, but we also have families where, the parents own a policy on the children. So those don't have to be the same person. And so knowing that, we can say, hey, maybe you're not eligible. We're going to try and we're going to see if they approve you, even though you have, for instance, type 1 diabetes or whatever. We're going to see if they'll approve you, but you also have an insurable interest in your wife. You have an insurable interest in your children. You might have a business partner. There is ways that you can do this, and the banking function, the IBC process, what we're trying to do on the living benefits side of this, you just need to own the policy. You don't need to be the insured to make that work. So when we're talking about these PUA payments, we're talking about how we're going to use it in the next section. Those are all things you can do when you own the policy, and you can own a policy on someone that you have an insurable interest in.
Yeah. Yes. So very simply, we're going to look at your family. Do you have anybody going up or down the chain, or business partners? Could even be your parents if you're young and they're still qualified. I mean, I know plenty of people in their 20s who have 40-something-year-old parents, and they could easily insure their mom and dad. That's an insurable interest. So you're not out because you have a health issue. Let's continue to dig a little bit if you want to take over the banking process in your life. So what can you do with it?
Yeah, well, the first thing is you can protect your family. We talk about protect, save, grow, the opposite order of operations as the conventional model, which just starts with growth assets. So the first thing you're doing by doing this is you're fulfilling that moral obligation that you have as a father, that you have as a head of household, to ensure that if you walk off this earth early, your wife, your children, your beneficiaries are provided for to the degree that you would have had you lived. That's the very first thing. If nothing else, if you never use this for any kind of IBC purposes, if you never bank with this, if you never take advantage of all these tax benefits, you are protecting your family. That's the first thing.
And beyond that, I mean, really everything comes back to, and we've mentioned it a couple times in previous episodes, but everything comes back to the number one problem that Nelson identifies in the book. And that's that you finance everything you buy. You either pay interest to an outside party, or you give up the interest you could have earned by whenever you do pay cash. So what that means is either way, your money's going to some outside entity and not staying in your own ecosystem. So the second thing we'll typically do with this is finance the large purchases of your life. Like Nelson identified, the average American family is spending over the course of their life 34.5% of the money that flows through their life goes to interest, whether that be on a mortgage or things they buy or everything when it comes to this problem that goes to somebody else's bank. So if we can start doing those large purchases, if we can start buying our own cars, paying for our kids' weddings, you want to buy a second home, maybe your mortgage, vacations, charitable giving. Like there's so much things you could do. Now, for me, I have a minimum threshold when it makes sense to take a policy loan. So I'm not going to put the company through the work if I have to spend $400 on a new snowblower. Like I'm just going to buy that on my credit card like a normal human being. But as the threshold goes up and I'm making larger purchases, if I'm going to go, replace a couple appliances in my house, I'm going to take a policy loan. That way, that money starts to flow back through my life. So we utilize it to do these large purchases, or we finance it. We take a loan from the insurance company that is used against our cash value as leverage. That way, our money continues to grow forever. It is leveraged. They're using our money as collateral. Our capital within the policy is collateral. So when we do that, we no longer face the problem of giving up compounding interest or that opportunity cost of our money when we pay cash. So we're going to take over the financing of everything we can out of this pool of capital that we're building. That's number two. The third thing, you could talk about it. You've mentioned it already, is investments, and you've kind of already started talking about that earlier. So run away with it, man.
Yeah. So this is just a way to do what you're doing in the market, in the world of risk, more efficiently from a position of strength and safety. I visualize it as building a wall of risk between my principal savings and any risk I want to take. And so this gets back to the idea of the and asset, a book by Caleb Gilliams, who's a big name in this space. We're not saying do this instead of real estate, do this instead of crypto, do this instead of index fund investing. We're saying do this as your foundation and go do those things. But that money comes from somewhere. And so if you're going to go make a purchase in a mutual fund, if you're going to go put a down payment on a rental property, if you take that cash out of where it's currently sitting, because it is sitting somewhere, it has to reside somewhere. When you move that from the bucket of the savings vehicle that it's in, move it over to the down payment, move it over to an investment in an index fund, whatever you're doing, you've removed it entirely from the bucket it was previously in. And so now any risk on that investment, if that investment gets cut in half or whatever, that all applies to that entire chunk of principal. Whereas when we borrow against it, we keep it in place where it is in this savings vehicle. We use it elsewhere. We're using OPM, other people's money. We're using the insurance company's money. Ours is not touched. And we'll get a whole episode into policy loans and why that is. But when I put money into an investment or put money down payment for a rental property, that pool of money, where that money came from, was never touched. So it continues to get that guaranteed compounding growth. And that's the real power. If I have to fire sale my rental properties tomorrow, I'll probably break even on them just from gaining some equity in the market. But my principal that I used was never touched. And so that's going to continue to grow. And again, if I want to leave a big index fund portfolio to my family, I can do that, but it doesn't come with many multiples of that as my death benefit as well. We want to do both of those things. We want to protect our family and save efficiently and securely and go take that risk. But on the investment side of what you're doing with this, you are building a wall of risk between your principal and your investments. But to drop it back down to the 101 level, okay, that sounds cool too. How do I actually take out a policy loan? How is this actually working?
Well, let's just keep this relatively simple. So the point is, when we do things now, when we purchase money and when we invest, we can have our money working in multiple places, right? So it never stops growing, and sometimes it grows in multiple places. And the policy loans, I want to keep this simple because I think this needs to be a full in-depth episode. So let's try this. I want to ask you a handful of questions and then kind of just tell it so we can see how wonderful the policy loan provision is and how effective it is. How much of a pain in the butt is it to get a policy loan?
Fire up my computer and log into my client portal on the website, and I click through the steps and request the money that I want.
Okay. Do they ask you? Do they do a credit check? Do they ask you for documents and your W-2s and 1099s and whatever else?
Nope. There's no underwriting. I am guaranteed approved for this already because I am a secured first line creditor. This is this is capital that I am the legal, my cash value. It's not just an account of money, but it's my spoken for portion of the total capital pool of the company.
Kind of like your equity in that policy.
Yeah, exactly. It is my equity. And so if I want to access it, I can do so with no questions asked, no credit check, no underwriting.
As hard as it gets, even beyond what he said, is as hard as it might get, is if your policy loan is beyond a certain threshold, and it varies by company, they might actually ask you to send a single page form in instead of just clicking online to verify and have a wet signature. But it's that simple. It's one page wet signature, and they're going to send you the money. And sometimes 24 hours, and it might be a couple of days if you get it transferred to your bank account. So the policy loan itself, there's a common misunderstanding out there. People think they're paying themselves interest, and there's a good reason for that. And it's one of the principles Nelson teaches that I want to get more in depth later. But the policy loan, does it have an interest charge?
Yes, I'm paying interest because I am borrowing someone's money.
Who's that interest charge that's attached to the policy? Who's that go to?
That is going to the insurance company who is lending me out of their investment pool.
Okay. Does that factor into the company's profits?
Yes, this is an investment for them, and it's actually the safest investment they can make.
It is. When the company is profitable, remember, it's a mutual company. So what does that mean to you?
That means that the company that I own, I'm a partial owner of, whose profits I share in, has made more money because they had a successful investment.
And so they're going to share some of that with you in the form of a dividend. And what the point I want to make there is that you are not, the interest you pay goes to the company. It doesn't go directly to you. A lot of people misunderstand that charge, the interest charge on the loan, does not go directly to you, but it does contribute to the success of the company. And then that company shares that with you. So indirectly, you do get, I don't know what portion, I can't give you, a ratio, but some bit of that comes back. And I want my company to be profitable, so I don't have a problem paying them interest.
And that's going to be an increasing portion every year, because the dividend distribution it's not as simple as just X percent goes to your account, but your share of the profitability is pro rata based on your ownership claim over the entire pool of capital. So as that grows, as we get those dividends and we put them back into the policy via paid up additions, we purchase more insurance with that. We are growing our policy and therefore our stake in the total capital pool. And so as we grow, we get larger pro rata shares of that profitability. And so there is no static answer, because it's going to continue to increase. And that's why these policies grow over and over and over.
Yeah, we just love knowing that the company is more profitable based on our actions, because we share in that, which is awesome. So, like I said, I wanted to really talk about policy loans in depth, and we're going to do that on another episode. But the repayment schedule, simply, if you were to go to the company and borrow $10,000 today, as soon as we sign off this computer, what's it going to look like? What are they going to tell you as far as how much you have to pay back and how long you have to do it?
They're not going to tell me anything.
So what is it? What do you mean there? How do you take a loan and
it is an unscheduled loan, because there is no default risk to the company, because they have that collateral that I'm using to basically stake and say, I want to borrow money from you. If I don't repay you, your collateral is the chunk of my money, which you already manage at the moment. Sort of. Now, those aren't precisely accurate terms, but they know exactly how much the value of my collateral is, because it's in my policy, which is a contract.
Yeah. So now, to be a good steward of the money, Nelson teaches us that if we're going to take a policy loan, we should always be making provisions to pay that back. We should always be practicing good banking. We want to be a good banker. So we're going to pay our loans back all the time. And he talks about paying the equivalent interest of what you could find out in the market, which right now the arbitrage is in our favor, which it wasn't necessarily last 15 years. And people scoffed because of that. And now it's a different story. So that's where that paying extra interest to yourself comes from. And that's where, like Hans just kind of mentioned, that it's going to go to some PUAs about a minute ago. So that's paying that interest back is what's going to happen. Now you need two of three things. You can pay these loans back however you want. They're unscheduled. So you can set that up yourself. You can say, hey, I'm going to get a bonus in 6 months. I know at work, I'm just going to use that and pay it off in one swift payment. That's fine. It's up to you. You're in control. Or you could talk to us, or you could go online to any calculator and make your own amortization schedule. And it's super easy. Like you need two things. You could say, hey, I want to pay $150 a month, and I want to pay this interest rate. How long is it going to take? Or you could say, there's three items. There's the length of time, the dollars you're going to pay back, and the interest rate. And if you have either of those two variables, you can figure out a payment schedule, and then you just pay it back. You just log into your account and pay it back from your bank account. Super easy. And they're also extremely favorable loans. And I know you love talking about that. So I'm going to give me the 50,000 foot overview of why they're favorable.
So because they are unscheduled and because there's no default risk, when you make a payment, it's not amortized over interest and principal like every other type of loan is. Every payment you make is going to be a principal only payment that entirely goes to reducing your principal. The other cool thing about this is that they compound annually rather than monthly. So it's not a huge difference, but a, say, 6% interest rate compounded annually is going to be less in interest paid than a 6% interest rate compounded monthly. and you just have to get into future value calculators to prove that out. But on all fronts, this is more efficient. And one thing to wrap your mind around when it seems too good to be true that there's no default risk is just remembering that if you were to die with a loan outstanding, for instance, an example, you have $1 million death benefit going to your wife and you have a $30,000 policy loan out. That's my current situation right now on my policy. If I were to die tomorrow, the company would say, hey, we owe your wife $1 million, but Hans already basically asked for an advance of 30 grand of it. He was going to pay us back whenever he wanted to, but because he hasn't, we've already fronted him that 30. That's already in your bank account. And so we're going to make ourselves whole from that. And here's your 970,000 tax free. And so that is exactly why they don't give you a schedule. You're going to repay them when you do, or you are going to die. And if there's anything outstanding, they've already given you that chunk that's outstanding. And so they give you the rest.
Yep. And if you choose to close the policy before death, the cash surrender value is just going to be decreased by the amount of outstanding loans. So somehow they're going to get the money back. So in the big picture
early.
here,
We'll buy it.
So yeah, never do that. Yeah, we'll find you a buyer. So if I look at this big thing, so when I'm starting this, we're going to supercharge this. We're going to engineer or design these policies by having a base and a PUA. So that PUA is going to give us early cash value up front. It's kind of like the rocket boosters on a space shuttle. So it helps it get out of the atmosphere supposedly, and then they fall off.
Allegedly.
And and the way we design these, we don't always like them to fall off. There's a couple schools of thought on that, but those PUAs are they're the rocket boosters, the early years of your policy. So they're going to give us a lot of cash value that we can start accessing immediately. We're going to access that through the policy loan provisions. And we just talked about how favorable those are. We're always going to use mutual companies. So remember, the concept of how we flow the money through these policies, it's not about necessarily just letting it sit, although that's okay too, is what's going to make our lives more efficient financially. Dividends are always increasing, cash value will always be increasing, and the death benefit, the way we structure these, will always be increasing. Anything to add?
I think that's a good overall. Yeah, that's a good summary. That's a good 101 to kind of, without getting too in depth. I know we might have gotten a little into the weeds. It's hard not to, just because we're so passionate about this. We tried to keep it at a 101 level, and I think that was a good summary at the end there. So that's a good place to wrap it up.
Awesome, man. Well, let's do it again. We'll, if you want to contact us, reach out, info@remnantfinance.com. Please like and subscribe.
Cool. All right. Cheers, man. We'll see you next time.
All right, brother. See you.